All right. Good day two energy. There was like one or two whoops, so thank you for that. I know everybody was out late last night, so people are still cycling in. Chris, how you doing, man?
Good. Good to see you, Ryan.
We're in part two of the experiments that is multiple one-on-one firesides with some of the best investors in the industry, some of the most kind of thoughtful folks in terms of these new frameworks for evaluating assets, for kind of thinking about token valuations and kind of what's going to move the needle over the course of the next few years. And Chris, you've been about as prolific as anyone thinking about standards. We were just talking backstage, 2014, 2015, little baby Chris.
Yeah, I met Ryan when I was 24.
Yeah, 24, working at ARK Invest, trying to put together the initial like valuation thesis for Bitcoin and the GBTC shares. And obviously, you and your team at Placeholder have continued to kind of push the envelope and had a number of theses around like how these things should be valued and how should we be thinking about where we are in the kind of general market cycle and then the kind of crypto market cycle in particular right now. So, why don't we start just with an update on Placeholder and how you're thinking about the world and really, what investment theses are core today, if they have stayed consistent, or kind of like how you're navigating now your second full cycle, I guess, as a fund manager.
Yep.
And then we'll go into some of the slides that you have and how you're thinking about the actual valuations per se. But first, a little bit about the firm, kind of the investment philosophy.
And I might skip to the first slide once I get into the thesis. But Placeholder's mission is to better distribute data, wealth, and power. And so we do that by working with decentralized information networks, also known as crypto networks. And we're a venture firm through and through. And when we got off the ground, there were more hedge funds than venture firms, and I think that has changed now. There are probably more venture firms than hedge funds. But despite being a venture firm, we also have a large public markets practice. So I was mentored by Cathie Wood at ARK Invest. I came to crypto from the public markets perspective, whereas my partners Joel Monegro and Brad Burnham came at it from the venture perspective. Joel was USV's blockchain analyst, famously wrote the FAT protocols thesis, which I still believe is alive and well, but we can come back to that, despite Cosmos' success. And then Brad Burnham, who founded Union Square Ventures with Fred Wilson. And so the reason we have both a public markets and a private markets practice is because we think that everything is still at a startup stage, and especially in a time like what we're currently in, there are venture scale returns in both the public and private markets. And actually right now, I would say there's almost more opportunity in the public markets than the private markets of crypto, because the private markets tend to lag the public markets. So while the public markets correct quickly, the private markets have a bit more inertia, and then the private markets will bottom later than the public markets.
Now, just to be clear on this point, are you talking about the public tech securities market, tokens?
Tokens.
Okay.
So pretty much, I mean, I guess I have some macro background from working for Cathie, but yeah, in this context, public markets would be public crypto markets, so liquid tokens like BTC, ETH, Atom, Sol. And so like if you look at the way we invest, while we have more venture names by number, so we're working at the seed or Series A stage and really helping entrepreneurs from the beginning, more of those in number, but in terms of capital deployed, we probably deploy more capital into the public markets. And we like to employ aircraft carrier strategies. So like in 1819, it was accumulating a lot of ETH and then investing in the ecosystem around ETH. And I think right now, in this bear market, there's even more opportunity to do that, of course, with ETH, but also with ecosystems around Atom or around Sol or around AVAX. And so in that strategy, you buy the core asset that's liquid. It still has venture scale returns. And then you invest and support the startups in the ecosystem around that core asset.
So why don't we do the quick summary of the three constructs that you want to talk about? So decentralizing data, wealth, and power.
Sure.
is the mission of the business,
Yes.
and it's also kind of the thematic
Definitely. Well, let
flow
me see.
of your.
Let's see. There we are. Yeah. So this was in our. This is publicly available in a thesis summary that Joel and I published either in 2017 or 2018. And I would say this underpins the entirety of how we think about crypto networks and their relation to data, and also the evolution of the information technology industry. So if you go back in time to the 50s and 60s, you had a lot of proprietary hardware systems consolidating around IBM. And it was really in 1971, I think it was, that the microprocessor came about as a standardized unit of hardware that allowed for a proliferation of hardware makers that also collapsed the cost to produce hardware. In collapsing the cost to produce hardware, hardware became prolific, and then it gave birth to the software industry. So explosion of innovation around the software industry, which once again consolidated around Microsoft this time. And so Microsoft was producing proprietary software. But once again, it was an open standard, or actually two open standards, that started to undo Microsoft's market power. It was TCP/IP to distribute information all over the world, and it was open source software. And so once you started to put pressure on the software services industry, people had to find another way to make money, because you now have more open hardware systems and more open software systems. And that really leads us to our current era, which is the data era, where you've got Google, Amazon, Netflix, all these companies, which really either provide you a proprietary service based on proprietary data, or a free service where they monetize your data and keep it proprietarily for themselves. Our argument would be that blockchains are open data standards. So just like the microprocessor or TCP/IP or open source software, blockchains are an open standard to coordinate around data that will put pressure on the golden goose of the current Web 2 incumbents, collapse the costs of coordinating around data, and therefore enable an explosion of innovation around it. And what we're going to do with that, we're in the midst of exploring. But I think it's key to make the data shared, open, and free. And just to give you an example, let's say you wanted a personal insight engine, right? And this is an engine that knows everything about me and can bring me content or goods or services that I want. In the current architecture of the web, you couldn't have that because you have all these data fiefdoms, right? You've got Facebook and Amazon and Google, which know slices of me. And so if I go and buy something like a surfboard, surfboard ads are going to chase me all over the web because someone didn't get the memo that I already bought the surfboard. Whereas if I have a repository that has all of my information and I own the keys to permission different services to access that information and then bring me either the information or the services or the goods that I want, that is an internet or a web that works for me, not against me. And I'd say right now with our current architecture, we have a web that often works against us in service of the data kingdoms, and we're all servants on their land.
You and I have talked about this before. I kind of think that there's two industries that we're talking about sometimes. There's Bitcoin, and then there's crypto, which is literally everything else. And we're going to come to Bitcoin at the end. That'll be kind of the bonus round. But for non-Bitcoin crypto, Placeholder is famous for Joel's post, in part famous for Joel's post, which you elaborated on in a few different kind of subsequent posts, this concept of a fat protocol. Mm-hmm. And when you look at the winners from these different eras, whether it's in hardware, software, data now, like today's big tech companies are all data giants.
Yep.
I would imagine, or if the fat protocol thesis continues to hold true, and certainly it's the case right now if you just kind of look at the basic market cap rankings, then big crypto is essentially going to come down to what are the biggest, most robust, secure settlement chains, right? So Ethereum, Solana, Cosmos, these standards.
Bitcoin with a different kind of settlement. Monetary settlement.
I want to put that
Okay.
aside because the limited functionality today, which I'll probably get lambasted for, but no one's using Bitcoin except for payments basically. So as much as they're trying to like make DeFi a thing on Bitcoin, or like an EVM type of machine on Bitcoin. So for right now, let's talk about the networks that are here. We had Mo on from Aptos yesterday. We've heard from the Mystic Labs guys. Where this is still an area where a lot of teams are innovating to build like the most secure settlement platform. How have you thought about the FAT protocols thesis now? Would you amend it? And do you think that those will continue to be the giants of the industry? With everything else kind of growing, hitting maybe some scale, but now it's starting to look a little bit more like enterprise SaaS or fintech,
Sure.
or like, you have other big companies within the space, but not $2 trillion companies or $2 trillion protocols like maybe the
Right.
FAT protocols will be.
So just to restate the FAT protocols thesis for those who aren't familiar with it, Joel argued very early on that in the current form of the internet, so this was Web 2, you've got protocols like TCP/IP or SMTP, or there's a whole variety of them that are not monetized. Mm-hmm. So they're very thin in value, and then and so that's the thin protocol layer in Web 2, and then it's the applications like Facebook or Amazon or whatever it may be that capture all the value. So thin protocol, fat value, thin protocol, fat application in Web 2. And then Joel argued that in Web 3, you're going to have an inversion, right? So you'd have a fat protocol in value and thin applications. And I would argue that's very much still the case. If you look at the value of Ethereum today, it's over 100 billion. Value of BTC today is, let's see, call it about 400 billion. Those dwarf the biggest application, which would be Coinbase. And I don't think Coinbase will ever be greater in value than Bitcoin or Ethereum is, unless one of those two is dying, right? And then even in the panel before this with Cosmos, I think that Cosmos is trying to create, say, thin pieces, loosely joined protocols, but those protocols still have a lot of value to them. And so it's not so much that there will only be a few protocols. There's going to be, our view is like 4 to 8 major base layer protocols, a number of middleware protocols, and then, a very wide number of applications on top, which are just thinner in value. And they have to be thinner in value because they're all competing globally and around a shared set of resources. And they also can't lock in their user, right? If you look at like Xerion or Zapper or say some of the application interfaces to the protocols, you can log in with your same wallet to Xerion and Zapper and pick your other interfaces of choice. And so there's no lock-in for the user. And so the application interfaces have to behave better. They have to treat their consumers better. They have to extract less. And then a lot of that value still circulates through the protocol layer.
4 to 8 base layer protocols, you think. Why so many? If you look at the browsers, if you look at mobile operating systems, if you look at the original OSs between Windows and Mac, right? Like it seems like it drops off pretty significantly. Why do you think that protocols are ultimately going to be different?
Well, it just came down to us from God.
What's that?
It came down to us from God. No, I'm kidding.
I mean, you're spending more time outside in Hawaii than I am, so like I don't know, maybe
I was meditating
a little bit more
beach
mystical. Yeah, the Don Draper final scene.
It's more say like I think you could look at it more from the major cloud providers, right? You've got Google Compute, AWS, and Microsoft Azure, and then like a lot of like players, smaller players of less consequence around that. So that would be to the lower side of 4. But I would say like if you look right now, and I'm still going to include Bitcoin in this, like layer 1s with pretty clear escape velocity would be Bitcoin, Ethereum, Cosmos, Solana. Layer 1s. And there are like layer 2s like ZK Sync or Polygon that have escape velocity in a higher layer. But so already I think you have 4 that are going to persist. There are other challengers, right, that are also strong. But that's where we're say minimum 4, and then there's going to be a war if we're going to get to another 4 slots to get to 8. and that'll really be determined next expansion. But already you have 4 with pretty good escape velocity.
All right, so I think we've set the stage pretty well for kind of the generation of crypto is here. I think most people in this room would agree. Maybe not everybody has unshakable faith right now, particularly if this is their first bear market. Like you and I are like seasoned vets right now. It's just embrace the pain, embrace the suck.
Yeah.
But why don't we go into the second slide
Sure.
here? Just thinking about how to. I think Perez, like her installation cycle, you can kind of go through this. I would love for you to not only kind of talk about this slide, but also talk about managing the psychology of this slide as an investor or someone that's thinking about making, maybe even if they're not an investor, maybe they're making a career investment or about to make the leap into crypto for a job or a startup. How do you manage with this in mind, and what do you build towards exactly?
Great. So I'll come back to the psychology. I guess starting with this, if you're in distress at this point in time, I would go and buy a book by Carlota Perez called Technological Revolutions and Financial Capital. And she goes through the last few centuries of major technological innovations, so things like the railroad boom and bust, which laid all the rail in Europe and America, and the financial frenzy that went around that, the automobile and highways, the telecom industry into the tech and telecom boom. And so there are these very predictable patterns, and she distills it into 2 major phases, the installation phase and the deployment phase. And then within each phase, there's a stage of, there are 2 stages. So in installation, which is where crypto currently is, you've got eruption and frenzy. So we've passed through eruption, and I should say that she outlines these as roughly 50-year cycles as a whole. And so then you're talking just a bit more than 10 years per color here. So we've gone through, say, the first 10 years of crypto, a little bit more. And that was eruption. That was the nerds tinkering, the cypherpunks working together. There was palpable disdain for monetization or marketing, or it was like, let's just nerd out and focus on the core concepts here, and very ideologically driven, right? And then I would say that in 2017, but then even more so in 2021, we saw this big cultural shift, right? Where marketing and business development became very key components of success. And the industry started to become much more financialized. We got signs of that in 17, but 21, it was loud and clear. And so that is a clear sign of the frenzy stage. And so the frenzy stage is really where finance comes in. Finance is anticipatory because finance is always pricing assets based on future expectations. And so because of that, the markets are always getting ahead of reality because they're saying, this is the future, and they're correct. They just, as humans do, take things to excess. And so we get these boom-bust cycles. And I would say that crypto gets the boom-bust cycles more regularly and more viciously because it's global, because it's 24/7. I remember running the math on it once. I think just the crypto markets are open at least 5x more than the traditional finance markets. So they're just always like processing information, and when they get momentum, they can just run away parabolically in a way that
5 times as much time to lose your money.
Yeah, like you could go and run the math, but like if you just think about equities, they're trading, I don't know, what is it, 8 hours or 9 hours in a day, 5 days a week. Crypto's 24/7, 365 days a year. So these movements run away with themselves. People are working globally. People are trading globally. And so crypto is very boom-bust. It also, just in the way blockchains as accounting systems work, it levers up really quickly and it levers down really quickly. If we look at Luna and Three Arrows Capital, yeah, it was a shit show. But what was amazing about it is, at least on the blockchain and smart contract side, the systems took care of themselves, right? There was no need for bailouts. It was just rapid and vicious deleveraging. So then how do I manage that as an investor? I would say the core is just remaining calm and you can see that people are losing their minds to the upside or downside. So last year, I would say that I had less desire to associate with the crypto industry because everyone was kind of manic. And it was a very intense, money-fueled, glitzy experience. And when you're seeing...
You're here on this stage. So this is a sign of the market bottom, right?
This is a bear market.
We're at or we're near the bottom because you're actually
This is great.
excited.
This is the best time. And then at the bottom, people are more depressed or without hope or whatever it may be. And so that's an easier time, at least for me, to be hopeful and to look to the future optimistically. And so another way to think of this is just looking at where liquidity is. So in a bull market, and this really applies if you're operating at scale in these markets, but the lesson is still useful. So in a bull market, everyone is buying. And that means that the liquidity is there for you as a seller because so many people want to buy. And then in a bear market, everyone is selling. And so the liquidity is there for you as a buyer. And so while Placeholder has a venture practice, which just kind of carries on and works with really quality entrepreneurs on a mission to better distribute data, wealth, and power, and we do that consistently, in the public markets, we're really a liquidity provider. Not in the sense of an LP in a balancer pool, but we're a liquidity provider in that we're pretty consistently selling in a bull market, and we're pretty consistently buying in a bear market.
So you're not just dumping?
No. No. And it's also like scaling in and scaling out. Mm-hmm. Like I think there's a fixation on timing the perfect top and timing the perfect bottom in crypto, which is unhealthy. And that pursuit of perfection generally leads to ruin. And it's better to scale in at levels that are meaningful and to work towards units of an asset that are meaningful to you personally or your firm. And so I'm always thinking of building units of the liquid assets where I can say, okay, if I have X units of this and it hits this price in the future, which I anticipate, then that is very material for my firm.
I want to make sure we have time for the last slide.
Yeah.
And then the bonus round on Bitcoin. So last one here, the J curve.
Yes. And this is really just the psychology zoomed in from the market level to an individual asset. And this was a paper I think I wrote, or a blog I wrote in 2017. It just looks at the J curve for a crypto asset. And it's really where the asset comes out. Well, in the white paper days, when there were widely read white papers, there'd be all this enthusiasm around the white paper. The asset would launch, it would go parabolic, it would have very little current utility value, but a bunch of discounted expected utility value. So its market price would be very high. Then we would descend into a bear market and basically converge on the current utility value with very little expectation in that asset price. That's a great time to accumulate the asset because then as you proceed into deployment, there's real use. So there's rising current utility value, but as people are hopeful about the future prospects of crypto and the asset itself, you have expanding discounted expected utility value. And then this would vary whether the asset's a commodity like Bitcoin or a cash flow producing capital asset, more like what all the staked assets are becoming.
I want to talk about the first phase of development here, right? So early is wrong in venture, right?
Yeah.
And what we're really looking at for the next couple of years is investing in infrastructure and this early development cycle with the expectation that there will be a repeat of the previous 4-year cycles. Do you think that this part of the J curve is getting longer with each subsequent cycle? Where do you kind of place chips and when do you place chips?
Yeah.
Or the fattest part of this chart, which is the development cycle.
Sure.
After a crash like we just had.
Well, so I would say we're still more in that infrastructure installation stage. So all the layer 1s and even the layer 2s that we heard from, that's infrastructure. That's just transaction processing bandwidth. And the analog in the past would be fiber. laying fiber. If you look at the mid to late 90s, as people were working towards broadband, right? Because through the 90s, it was really dial-up, and we currently exist in dial-up, right, within the crypto era. But we're working towards broadband. To get there, there was massive deployment of fiber all over the world. A lot of those firms got destroyed. But they did the service for us of deploying fiber at scale such that it was really cheap to provision the services of the web. And then that gave rise to a lot of the application companies from the 2000s that we know well, like Facebook and Twitter and Snapchat and whatever. So right now, all the money going into layer 1s and layer 2s
is going to be incinerated so that the apps can rise.
Exactly. Exactly. And then there will be some winners. There will be some major winners. But many will be sacrifices that then make it super cheap for the application developers to experiment, the users to play around, not paying $100 for a transaction. It's hard to experiment when you're paying $100 for a transaction. And similarly, it used to be when you accessed the internet in the 90s, like you were paying per hour, or you had like a specific amount of time, and then like all you could eat was like a revolutionary thing, but then it was still just within AOL, and it took some time for like truly all you can eat and getting video and music and a much more interactive experience.
We've been very meta in this conversation. I guess specifically on the infrastructure side, what are the things you're looking at most closely? Is it core infrastructure that may have been built on Ethereum but kind of replicated for Solana and Cosmos and some of these other BAT protocols? Or are you looking at the application layer primarily? Where do you think in this kind of early stage post-correction you're going to get the most bang for the buck?
So in the public markets, which is where I've been spending a lot of time this year, the public crypto markets, there's a lot of very high quality infrastructure that has what I interpret as escape velocity that is very cheap, down 80 to 90% plus. And so a lot of my focus on the infrastructure side is in the public markets and building scaled positions. And then a lot of the venture work is with application teams building on top of that infrastructure.
We have 3 minutes left.
Yeah.
We got to talk about the king.
Oh, the king. OK. That's you, right? Oh, no, that's this guy.
Bitcoin. Well, I'm the king for a day with this conference. But we were talking backstage. Everybody, it feels like everybody's just shitting on Bitcoin. I think maybe it's because like Bitcoin maximalists on Twitter are not the best messengers or brand ambassadors.
They're tough. They're tough.
I compared them to the sparrows from Game of Thrones, right? That kind of feels like the way that Bitcoin Twitter is triangulating. But if we just take out all the craziness and some of the fringe elements of the community, it does feel like people have just forgotten about Bitcoin. It's like a little bit of a disrespect. It's like almost a part of the cycle where everybody forgets that Bitcoin will be here for forever until the heat death of the universe. That's how I feel.
Makes me feel old. It's the
but you mentioned it backstage, which
yeah, the people are shitting on the king, and the new kids forgot where they came from.
How do you think about Bitcoin in the context of managing a crypto fund? Because yes, you've got investors that just want to have you as part of their investment allocation, like a emerging asset class. Sure. But you also kind of have to beat Bitcoin as the benchmark, right? Like, so how do you think about Bitcoin-related infrastructure in that context? So, and are you incentivized to ignore it?
Yeah. So I would say that I can't talk about the fund specifically because we're SEC registered investor, but we have spent time on Bitcoin, and it's my roots. I mean, when we were speaking in 2014, like that's really all there was, and Ethereum was in the white paper stage. But so why is Bitcoin important? Bitcoin's important because it's really a conservative mirror that will never change, that reflects the craziness of society. And society is very crazy, and central banks have a lot of power. Humans tend to abuse that power. And Bitcoin is a good reflection of the abuse of power. And when you look at like when liquidity is sloshing into traditional markets, when the dollar is weak, that tends to be soaked up by Bitcoin, as you could also call it a sponge. You know, it's a liquidity sponge. And so the fact that it is this unchanging thing in an ever-changing world makes it valuable. We've never had enforced scarcity in the way we have it with Bitcoin, and you could only have its severity of scarcity in the digital world. And so while it's a very different thing from pretty much the rest of crypto, the only thing on par to BTC is maybe Zcash, and that's going to be something interesting to watch. But providing that check and balance on central banks and being a mirror, a liquidity mirror for society, is going to always be important.
I'm waiting for David Hoffman to rush the stage, just shouting ultrasound money. Do you think that the merge has changed the staying power of Bitcoin in the sense that Ethereum is going to be net disinflationary, potentially deflationary at scale?
They're so different, and also in their mindsets and their developers. And I think that the merge is actually more relevant for all the other layer ones of showing the demand for ETH and how even though protocols don't operate on traditional metrics of profitability, but the demand to transact on ETH increases the value accrual properties of the asset. And so that is important for other layer ones to pay attention to and to contend with. But ETH is so different in design and philosophy and why you would hold it from BTC, at least for me and a lot of institutional investors I speak with, that I just think of them totally differently.
Chris, thank you for joining us.
Thank you.
Good to see you in the bear market.
As always.
We get, the good and the bad is, we've talked about it before, there's 1 year of like a bull market and there's 3 years of bear market. But that usually means that there's 3 years of Chris and 1 year of surfing,
I'm happy 3/4 of the time, and I disappear the other 25%.
Welcome back.
Thank you.
Thank you.
Thanks, everyone.